We're seeing a major escalation in the US-China economic standoff. China has for the first time invoked its 2021 blocking rules, ordering domestic firms to ignore US sanctions targeting Chinese refineries accused of importing Iranian crude. China has called these sanctions an improper use of extraterritorial law by the US. The move creates a direct legal conflict. Multinational companies operating across both markets now face a binary choice: comply with US sanctions and risk violating Chinese law, or follow China's directive and face potential US penalties. For global banks and firms with dollar exposure, the risks are immediate, especially the threat of secondary sanctions tied to the US financial system. This confrontation is unfolding against a backdrop of a major shift in global trade dynamics. In 2000, the US was the dominant trading partner for most of the world, with total trade exceeding $2 trillion, more than 4 times that of China at the time. But over the past 2 decades, China's trade has expanded rapidly, growing over 12-fold. By 2024, China's total trade has crossed $6 trillion, overtaking the US, which stands at roughly $5.3 trillion. Today, China is the largest trading partner for a majority of countries across Asia, Africa, and Latin America. This expanding economic footprint strengthens Beijing's ability to push back against US pressure. The timing of this move is significant, coming ahead of the much-anticipated visit by President Trump to China. Beijing's move signals a tougher negotiating stance while also setting a precedent. Analysts say this could mark the beginning of a competing legal framework governing global trade. Countries like Russia may take cues from China's approach to counter unilateral US sanctions. The broader risk is fragmentation, where companies, banks, and even countries are forced to align with one system over another, a trend that could accelerate the decoupling of the world's 2 largest economies.